how to buy apartments in the next 90 days. How can you do it? How can you find? How can you analyze? How can you raise the financing? How can you close and manage these deals in the next 90 days? And how can you execute on that? I'm going to show you that this evening. But I think more important than anything, and it was really important for me about a year ago, even though we've done this and grown and done what we've done on a professional level, I had to dive a little bit deeper and get into the why and some of the pain a bit as to why you're pushing yourself, why you're going through this, and why you're trying to make all this money. Because it's not about the money, right? I mean, the money simply gives you choices. It gives you tools and choices to be able to go really do the things you're trying to do, which is have a little bit more free time if you're in a job you're having to go do every day, or it's giving you more time with family to travel and have experiences, or give back, philanthropy, your church, things that are most important to you. But money is simply a tool and choices to allow you to do that stuff. I'm sure you'd all agree, correct? I'm going to throw up a little quiz poll. Actually, we'll do a poll first. I'd like to know, why is everybody here tonight? Why is everybody here tonight? Is it the passive income side of it? Is it to build retirement for yourself? Is it to scale big, right? Multi-millionaire in the multifamily space? I think you can choose multiple in there. Maybe you want to get out of single family home rentals or flipping or wholesaling, other types of real estate investing, and get into multifamily more. But I'm curious as to why you're here tonight. So surprisingly, this is interesting. Scale big, become a multimillionaire. I love it. And why do you want to become a multimillionaire? Is it simply to have the choices, probably do the things you want to do? That's what I'm guessing. But that was a majority. Then obviously coming in second place, passive income, get more time with family and travel. I love that. I love that. So cool. Let me close that for everybody. So has anybody ever seen this before? The 7 mountains that move a nation and inspire people. The 7 mountains that move a nation and inspire people. And why is this important? Okay. I'll kind of fast track that so you can see them all. I was at a conference in September of last year. It was a Patrick Bet-David conference in Florida. And I'd never done one of these self-identity kind of exams before, where you're really diving into things that move you, inspire you, because we all have different ones, but there are 7. There are 7 that will move you in one way, shape, or form and inspire you to get up every day when you don't want to get up. If you've made all the money, it's going to still inspire you to go get things, right? So sports and culture, family, media, government, business, education, and religion. So I would ask you this right now as you're kind of getting going in this. You didn't know this was going to be a motivational thing tonight, did you? But a little bit. Before we get going, sports and culture, family, media, government, business, education, and religion, which ones, and pick 4 that are most important to you, And to kind of give you an example, okay? So out of these, sports, culture, family, media, government, business, education, okay, and religion, which ones are most important to you? Think of the top 4, write them down and think about them. And I'm going to give you mine to kind of give you an example of how you can do this exercise, okay? How you can do this exercise. So mine starts with business, okay? Because you have to have a successful business or career or whatever it is you're doing to have the money to then give you the opportunities and choices to go do other things that you're really passionate about. The other one is the media side, right? And having a chance to interview people, do podcasts, learn about these things, and put things out in the media world to then grow a community of people that you're surrounded by. So the media is number 2. That kind of inspires me to do things, right? Then additionally, obviously family. But it's not just your family, right? It's not just that. It's philanthropy, right? Giving back. Maybe there's causes that are most passionate to you that you care most about. For me, there's a few of them. We give back a lot to Tunnels to Towers. I don't know if you ever heard of that organization. It started after 9/11. And what they do is they actually go out and pay off the mortgages and give spouses, widows with their children, free and clear homes. They pay off their mortgages and they give them a free and clear house so they can live in and have security and safety for the remainder of their life because their spouse died in the line of duty or as a first responder. Pretty amazing. Started after 9/11. So we really support that. Seal Future Foundation. We're huge on that. I'm golfing in a tournament for charity on Thursday that helps get back and transition a lot of these Navy SEAL team guys from their team life into civilian life, because that's a hard transition mentally, right? Emotionally, physically, all of that to get them going. And then disadvantaged kids, right? Helping kids that maybe didn't have similar upbringings, maybe parents in the home, et cetera, like disadvantaged, to kind of show them and mentor them to become great and believe that there's great things out there for them. So those are my passions on the family side. And then the education. This is why we're here tonight, right? Creating a community, educating, helping people grow, get a lot of fulfillment out of that. I don't know how you are. So really back to that, think about it, chime in the chat real quick. Just want to hear it in there. You're four. Type them in. What are your top four? Because I think that's really key, and keep this in mind as we go through this tonight, because that's what's going to drive you to take action and do things after tonight in the multifamily space. Okay. So which one of those four are most passionate to you? Okay. Awesome. You got them? Perfect. Love it. Family, business, education, media. I love it. You're copying. No, I'm just kidding. Thanks, Mark. I love that. Honey, family, business, religion, education. Love it. Perfect. And then, why are we really here tonight? It is about community, because what you're going to learn and what you will learn very soon in the multifamily space, more than any other vehicle in real estate investing, is that partnerships and community are how you grow. It's how you can take on bigger properties. It's how we got to 500 plus units, which is where we're at today, and 150 plus million in assets. You don't do that alone. Most people can't take down a 20, 30, $40 million apartment asset alone, let alone a $10 million one. So you need partnerships and people and collaboration. That's how you grow. So that's why we're here, right? That's why we're here. That's the benefit of being a part of this, is we can actually train, teach, educate good investors to go execute, be successful. And by that, they come into the community. And then what do you think happens? Partnerships. Then, we're sitting down here in San Diego, and then we have an office in Texas. But, we're over here in Missouri. We got a little bit of Oklahoma here. We got Arizona, Nevada. But we would love to be in the Southeast. We even love some of these areas up in here in the upper Midwest. But we can't see every deal. So we love collaboration and community and partnerships, because then we can do bigger deals too alongside people. You can get in and execute and have a lot of success and become a multimillionaire. Everybody wins. That's why we're here. Okay. It's all about this. Okay. It's all about this. That's the big, big sign behind it. And that's why people are doing stuff, right? In the community. And all these people are doing deals and executing. And these are just some examples, but that's ultimately why we're all here tonight. That's why we're all here tonight. Okay. So now we're going to take a little quiz. And I love that. Peter, family, religion, business, education. Steve, family, business, religion, sports, and culture. Actually, that's the first time I've heard somebody say sports and culture. I'm curious, why? What about sports and culture is exciting to you? If you can chime in, I'd love to know about that. I want to know. Old football player in college. Love it. I did high school football, wide receiver and cornerback. Was pretty good. Not good enough to go to college. I was a baseball guy. So I went to college for baseball. Ended up riding the pine. Wasn't good enough. They were a top 25 team. I wasn't able to really get into the big side. But throwing up real estate experience. I'm curious. Everybody, are you brand new novice? Have you done any deals, flips, wholesales, anything like that? Own any single family rentals currently? Currently in multifamily. Love that. Cool. Here we go. Has anybody seen this before? Maybe you've seen it in some of my other videos, possibly. But I'm curious as to if you've been taught this before, because this is really what we call the 5 pillars. Okay, the 5 pillars. And it's the method that we teach, because every single rental property, okay, especially multifamily, is going to flow through each of these 5 pillars. And these are sequential, right? You have to find the deals. How do you find the good deals that pencil? Especially in today's market, higher interest rates, sellers want X, buyers want to pay Y. There's a discrepancy. How do you actually find these deals that are on and are off the market and get into them? How do you analyze these things pretty quickly to determine, is it a good deal? Does it make sense? Can you actually move forward to the next stage, which is making an offer on it and learning how to finance and close, right? Stages 3 and 4 is great. We found the deal. We've analyzed it. It makes sense, Justin. How do we take the next step in actually writing an offer correctly, negotiating it, opening up escrow? Oh crap, we got to raise the money and do all this stuff, finance this thing and close with as little out-of-pocket money as you can. And how do you do this? Well, it is partnerships and it's a thing called OPM, other people's money. You've heard those terms. I know you probably have online, but how does it really come together? How do you structure it and put it together? I'm going to show you that this evening in a very simple format. And then we're going to open it up to Q&A so you can ask away, right? I am literally a dictionary for you tonight and hopefully answering all of your questions as I can. And then lastly, how do you manage it? So great, we've analyzed, we've put in escrow, we raised the money, closed it. I own this beautiful 10, 12, 20 unit apartment building. How do I manage this thing? Or more importantly, how do I hire the property managers? So that way I'm not dealing with the toilets and tenants every day, and I can still do my current career or job because that's paying the bills right now, bringing in the income to me and my family until this, right, chunk over here of multifamily starts paying me enough money to say bye-bye over here, right? You have to make that transition, and it takes time, a little bit of time. So, and I can give you my story on it, how I did it, because I transitioned out of doing luxury home sales for 10 years along the coast in Southern California, all the while buying some multifamily until the point where I flip-flopped the income, and now I'm nearly 100% out of that, okay? So these are the 5 pillars that I'm going to go over with tonight and walk you through each of them, but I'm going to be focusing kind of in this area here, okay? Kind of in this area here. Because these are the areas that most people have challenges, right? Finding, analyzing, and financing. Finding, analyzing, and financing. And we're going to go over that mostly this evening, okay? So how do we, okay, get you into a multifamily deal in the next 90 days to locate one and start moving into one? How does this happen, okay? Here's how it's going to go down. First of all, stop looking or listening to people who are telling you to go after big deals that are 50 plus units for your first deal. It's never going to happen. And there's a reason why it's not going to happen, especially if you're a novice, as it appears most of you are, which is great, but there's no chance. You have a better chance of breaking into the White House than landing a 50 plus unit deal and doing it mostly on your own. It's just because of the way it works. You're not going to get the brokers. The more sophisticated brokers play in this space. More sophisticated sellers are in this space. More sophisticated money and bankers and lenders and financing and everything is in this space. So they're going to require that you have a decent amount of experience before you're ever going to get your hands on that, okay? Unless you have a partner or somebody right now that you are literally partnered with who has that experience, there is no chance you're landing that, okay? So here's how you're really going to do it, okay? And let's get off the guru track of all these people online telling you all this stuff. No money down. You can go after, go big or go home on your first deal. Listen, it sounds nice. It's great catchphrases. It's just not realistic. Not realistic. So bye-bye to that. If you're a novice, you're not touching that. Here's how you're going to do it. You can go in the marketplace today and somewhere in the 10 to 30 unit range, you can locate deals that make sense in a market, right? Depending on where you're at, that you can execute on. And how do you do this? How do you start the process? Okay, there are marketplaces online. You've seen them, LoopNet, Crexy.com, CoStar. Those are the main websites you see out there, similar, right? If you were going to go buy a house today, if you were going to go buy a house, you'd go on probably Zillow, right? Trulia.com, Realtor.com, right? Some of those websites, Redfin.com. That's how you'd go find single family home, correct? Well, multifamily, we recommend Crexy.com. They're actually a partner. Their head sales team and guys are in our programs today, and we love them, right? We love them. They're very good at what they do, but you can leverage this marketplace, right, to get access to the on-market properties, okay? So why is that important? Because what you're going to do is you're going to leverage the on-market to get to the off-market. You're going to leverage the on-market to get to the off-market. What do I mean by that? Let me show you right now. Yeah, I have a deal, sharing my screen with you, okay? I just pulled this up. This is in Missouri, like a random property. And this is an 8-unit deal, okay, on Crexy.com. And all I want to do is this. This is how it's going to go down. Let's say that Missouri was a market I was interested in, which it is. We're in Kansas City. But let's say I was just new and I wanted to go into Missouri and I was interested in Missouri. Well, what I'm going to do is I'm going to go into the market that I'm interested in and I'm going to locate 3 properties, okay? 3 properties. From there, you get 3 brokers. This is how you start, right? You can go more, but I'm just saying this is how you start. 3 properties, 3 brokers. I'm going to call Mr. Matt. I don't know how you pronounce that last name, but Matt B. Hey, Matt B, this is Justin Brennan over here at the Brennan Poley Group Capital. Hey, I'm taking a look at your property here on 5744 Pershing Street in Missouri there. Interested in it. Have you got any other showings on it? Kind of what's the activity? Okay, had a few showings. Looks like you've been on market a little bit. How do you set up your tours? Are they in person? Do you do group tours? Do you do individual tours? How do you tour the property? Okay. Okay, so you do one-on-one tours? Awesome. Hey, I'd like to schedule that if I can and come take a look at it. We're an investor in the marketplace. We're interested in this little property, this 8-unit. How does next week work? Okay. Yep, we can do the morning time Wednesday. Perfect. Now, they may ask you some additional questions. This is all the stuff this is the nuance, right? I'm not going to get into the nuance tonight, but this is how the process goes. Okay, great, Mark or Matt. Thanks so much. We'll set that for next Wednesday. Okay, same thing. I'm going to do this on 2 other properties in the market. I'm going to go tour those properties. Right? I'm going to meet the brokers. I'm going to shake their hand. I'm going to hand them a business card. I'm going to look them in the eyeballs, and we're going to make a little connection for a few minutes. And then what's going to happen is these deals aren't going to make any sense. Okay. Okay. These deals don't make sense. Right? 95% of the ones on any of the websites don't make any financial sense. That's not the point. The point is you're leveraging those to get access to the brokers who clearly have more deals. They just don't have them on the website. So this is how it goes down. If you took 100, actually, we'll just take, if you took 10 properties, okay, 4 of them, 6 of them. Website, pre-market, sale, okay, 60% or more sell here. 40% will sell on the website. That's how the market works. It's completely a flip-flop. In residential, 90+% are on the websites and sell through the MLSs and the websites and everything you see online. Okay. Complete opposite in commercial real estate. 60% are pre-market. So this is how it goes down. That broker is calling the seller on this 8-unit deal, and they're saying, hey, Mr. Seller, they get them all enticed, excited. They call me all the time. Hey, would you consider an offer on your property? Great. Yes, we would. Timing's right. Okay. Great. Can you send us over the financials? We're going to analyze the property and give you a broker's opinion of value. Great. Okay. We like the price you're presenting to us. You're going to go ahead and pre-market this thing. So what they're going to do is take it, pre-market it to their database of investors, which you could be one of them. And now you're getting access to the pre-market deals before they go on the website. Because if it doesn't sell here, that means it's overpriced. That's why it went to the website. It never makes it to these websites if it's a good deal. The only reason it's on these websites is because it stinks. 95% of the time. 95% of the time. Now, it's not that you can't negotiate them down. So things will sell on the websites, but you got to negotiate the heck out of them because you're going to analyze them and they're 95% of the time, they're not going to make any sense. Okay. They're not going to make sense because this is an important concept of finding deals, right? You're hunting, but you're using the on market as a lure to get access to the brokers and their pre-market opportunities. And that is how we grew. That's literally how we did our first and even our current deals today. Is we leverage all of our connections with the brokers, but we've done it through the on-market opportunities to get access to their pre-market stuff. So,
hey, Justin, can you hear me?
I can hear you. Yeah.
Awesome, man. Yeah. I just had a quick question about multifamily units that are potentially in foreclosure.
Okay.
What exactly is like the process with those? If someone is in foreclosure, is that like a good opportunity to look into? Or should you stay away from it? Would you recommend it for someone for their first deal?
Okay. Yeah. So yes, multifamily does go into foreclosure and they are out there for sure. You'll get access to most of those either pre-market through the brokers who have the connections, but this is why it's going into foreclosure if they finance it wrong. And what you've seen happen with the high interest rates that are in the market today, there's a complete S show going on in the commercial real estate space. Because if you can imagine this for a minute, all the interest rates were super low, as we all know, all the way up until March 2022. And then by March 2022, they skyrocketed as the Fed raised all the interest rates. Yeah. So anybody who is doing multifamily and putting variable rate loans on these properties, and then the rate went from 4% to say 9% almost overnight, they're having serious problems paying that loan. So now it's going into default, right, and delinquency, and sometimes becoming a foreclosure. So you can get access to those bad loans by way of the brokers. You can negotiate those. In multifamily, I'm sure you've heard of things in single family space called sub two, right? Creative financing, stuff like that. Those are the terms you kind of hear, right? Sub two, and or you hear the creative financing or seller financing, all that stuff, right?
Yeah.
So those are the main terms you hear in the single family world. So that doesn't really exist in multifamily. It's called assumable. Because most loans are assumable in commercial real estate. Most, not all, but most. So you can assume that loan versus taking it subject to, right? Subject to.
What does assuming the loan mean exactly?
You're taking on the exact amount of the loan, the terms of the loan, everything about the loan. You're taking on that loan. You're not paying it off when you buy the property.
Got it. So similar to a subject to, just different.
Similar, it's just different terminology and different processes, right? And it's all above board, right? Because technically, when you do sub two, technically, the lender can call the loan. Correct. Because most residential loans have a term in them in the loan docs that do not allow you to subject to any of the loans. Like if you're transferring title on a single family property and you're not paying off that loan to that lender, they legally have the right to call the loan, just so you know. Now, it doesn't happen that often. It's very rare, but subject to is technically illegal.
Oh, is that what due on sale clause? Is that what that means?
Correct.
Or is that a different concept? Okay.
That's exactly what it is. And it's in the loan documents. But again, there's the legal and then there's the gray line.
Got it.
You get my point.
Okay. I have a question.
Creative financing, creative financing, all that means is the seller may be doing some financing for you, providing some loans. It's creatively being put together. There's many, many ways to do that, and you can structure it the same way in multifamily. So that's how you can handle that.
I have a quick question.
Yeah.
So when you were first starting out, I mean, like, how many brokers were you reaching out to, and like, were you ever bringing them in on the deal, or how, you know what I mean, like any creative kind of concepts there?
Yeah, funny enough, a lot of the brokers, because they're in commercial, they're a little savvier. So they love to get brought into deals. So we've done that a couple times, not always the case. As I said, in the beginning, right, I want to keep it very simple for everybody. In the beginning, 3 properties, 3 brokers. 3 properties, 3 brokers. Ring, ring, ring. Like that's how the process is going to start in the market that you're interested in. Okay. In the market you're interested in. And then from there, you can grow that pool, but start with 3. We started with 3. I mean, our first deal out of state, out of California, was in Kansas City, Missouri. It was a 27-unit deal. And we found that deal by way of a local broker in the marketplace. I called a few, saw some properties on market, went out to Kansas City in January. Bad idea. I mean, it was freezing, but it was great. So toured 3 properties, met with 3 brokers. None of those deals made sense. That wasn't the point. I made a little bit of a relationship, said, hey, broker, look, it looks like this deal's not going to make sense, but we're buyers in the market. We're buyers in the market. We're going to buy here. So I'd love to get access or get into your email list of some of your pre-market stuff where I can take a look at them and we can actually maybe pick stuff up before it's hitting the major websites. Would that be okay? And then that's how you're going to start to get the access. But you got to build that little bit of rapport, right? Remember this, the more hands you shake, the more money you make. And the more hands you shake, the more money you make, guys, in life and period. The more hands you shake, the more money you make. That is how it works. Neil asked a cool question here. Do you have scripts for those brokers? The answer is yes. For the people that are in our mentorships and mentee programs and stuff, absolutely, because we teach that. I mean, that's the nuance that goes into this. So absolutely we do. Great question. What makes a good deal? So starting on step 2, which is analyzing, right? Remember those pillars, finding deals, analyzing deals. So now we're going to get into analyzing deals, how you would analyze them. Obviously, we have deal analyzers. We have all this stuff. I think actually when you signed up here, you may have gotten an email that has one of our kind of free deal analyzers for you to have. If you didn't, let us know. We'll have you put stuff in here at the end and we can get you access to that. Very easy to do. Okay. But what makes a good deal? Simply put, and these are terms you may have no idea about. Don't worry. Don't worry. IRR, that stands for internal rate of return, similar to an annual rate of return on your money. Okay. So you want deals that are going to show you on the deal analyzer 14 to 20+% annual rate of return, internal rate of return. Okay. Cash on cash. That's what that stands for. Cash on cash. Cash on cash. So which means money goes in. How much actual percentage on that cash am I making every year? Okay. 6 to 10% at least every year on the cash in. Okay. On the cash in. Equity multiple. That's what that stands for. Equity multiple. You want that to be 1.8 times or more, which means if I give you $100,000, I'm getting $180,000 back. If I give you, if it's two, like a 2x, 100,000, 200,000, right? Equity multiple. Okay. So those are the things that supplant what a good deal, meaning if you analyzed it real quickly in the deal analyzer and those numbers showed up, okay, great. We're going to consider going forward more. So you're going to dive in. You're going to dive in. Perfect. Okay, cool. So those are kind of what, from a high level, the main metrics you're looking at for what is a good deal. 14 to 20%, cash on cash of 6 to 10 plus, equity multiple of 1.8 plus. And then for that point, you can move farther in. Okay, and you utilize our deal analyzers. There's other deal analyzers out there for multifamily, but you can get ours this evening, no problem. Okay. Perfect. Let's kind of jump in a little bit farther on the analyzing the deal part. Okay. I'm going to change to green here so that way you can see a little bit better. How do you guys like these vibe boards, by the way? Does this help kind of illustrate things versus like being on some lame little Zoom where I'm sitting there typing away and that's all you get? Like you're actually getting like a live class. It's kind of cool. Beautiful. Okay. So analyzing deals, you're focused on this beautiful term called net operating income. Net operating income. And why that is so important, apartments, unlike residential properties, all right, if you're going to value the property like a home, a single family home, you're looking at the comparable properties in the area and then comparing it, adjusting accordingly to find its value. With an apartment complex, it is its own business, literally. It has an income, it has expenses, and it has a profit, which is net operating income. Based on that profit, you establish a cap rate to it, right? We'll get into that in a minute. And that gives you the value. So the better you make this number, it doesn't matter. You could literally have the exact same buildings, exact same finishes, exact same quality, exact same location, exact same everything. Two buildings, identical, side by side. And the NOI of this one is $1 more than the NOI of the other one, which is $1 less. Okay? This building, because the NOI is greater, that one's worth more value. And this one's worth less value, even though literally they're identical. So if it was a home, if there were two homes, you would say, gosh, they're identical houses side by side, identical everything. They're valued the same. No, not in multifamily. It's all about the NOI, okay? Net operating income, okay? Net operating income. So cool. So let's work through a basic, okay, financial statement on a multifamily building. Okay, so you take any rental property, and this could be literally single family rental, doesn't matter, but let's presume it's a 10-unit multifamily building. You're going to take the gross income, gross rents that thing is producing every year or month. You're going to remove what's called economic loss. Economic loss includes vacancy, loss to lease. Loss to lease is the difference between market rent and what you're getting. If your rents are the same as the market, great, you have zero loss to lease. If you're getting less than the market, you have some loss to lease, okay? That's loss to lease. Bad debt, people not paying their rent. Concessions, you have to pay people and give people credits to move into your building. So you take all that into consideration, okay? It's going to be somewhere in that range, right? So 8 to 12 for vacancy, 1 to 2 for loss to lease, bad debt 2 to 3%, concessions 2 to 3%. But that's kind of how those percentages would break down, and that comes off of your gross income. So you'd take off about 12 to 15% off of your gross income is going to get you your effective gross income, okay? So gross income, less economic lease, other income includes, you could have some parking income, laundry income, pet income, late fees, admin, all kinds of other income line items. Like on our apartment buildings, we have some 100+ unit deals, and they have like 30 different line items for other income that we're generating on. If you live in an apartment complex now, you probably have some other income items that you're paying on each month on your bill, right? So that's other income. You get to operating or effective gross income, right? It's what that stands for, effective gross income or operating income, right? Then you take out expenses, property taxes, insurance, maintenance, repairs, property management, right? Expenses. And then you get to your beautiful number of net operating income. Net operating income. Now, if you wanted to know how do you establish the value of any multifamily building, it is a simple formula. The value of the building equals the net operating income over a cap rate. The value equals the net operating income over a cap rate. It's a basic algebra problem. If you know 2 of the 3, you can figure out the 3rd. Okay. So if you know the net operating income and you know the price that they're asking, the net operating income and you know the price that they're asking, you can figure out the cap rate for the market, or at least for the property. Now, let's say you want to figure out what the cap rates are, because I get this question a lot. How do we figure out cap rates for a market? Well, we have websites in our programs that people can go to and they can see the cap rates in the entire market for the country. Setting that aside, you can ask brokers, you can ask people in the market in general, but the brokers are going to be kind of your gateway to that area and saying, hey, where are things kind of trading for this type of property, right? That would be the language you would use. What are the types of cap rates that are going on in this market for this type of property? Where are they trading at? And they're going to tell you, okay? They're going to tell you. So let's say that the net operating income was $1 million and the cap rate for the market was 6%, okay? Then the value of that building is $16.7 million. $1 million over 6%. $1 million divided by 6% gets me that, okay? That's how you establish the value of any building, okay? That's how you analyze them. So in simple format, to kind of rehearse this again, take the gross income, take out your economic loss items. The deal analyzers do all this for you, by the way. So they're literally plug and play. So, but from a paper side of it, so you can kind of comprehend it, that's what we're doing, okay? Working all the way through. So that's how you would evaluate a rental property. Then at the end of the day, of course, you got to take out your loan to get to this free cash flow number, okay? Any questions on this so far? You guys are getting a whole litany tonight. I love it. But we're going through it step by step. So that way I can try and keep it in simple terms. And that way you can, I mean, this is a recording too. You can replay this if you want it as well. I think they will send that to you when you're done tonight. So that is the basic finances of how you're going to break a property down. Okay. That's how you're going to analyze the deals, focusing on net operating income, right? So let's go to the money side. The big elephant in the room. How do we finance these babies? So imagine for a minute, we found a 10-unit apartment building, okay? And we've analyzed it. And the numbers make sense. It's fitting into those metrics of 14 to 20% a year, 6 to 10% cash on cash, an equity multiple of 1.8 or more. So it's meeting all the metrics. We're like, oh gosh, this thing looks pretty good. Great. Well, how do we finance it now? How do we put it together? How do we put it into escrow? How do we structure the deal? How do we bring in investors if we want to do that? What does that look like? So all these questions are going to start coming in. We're going to address that right now. Okay. So raising the money. Obviously, you have debt. That's your loan. And then you have the equity, which is your down payment. And it's really brought into those two things. Where a lot of people make the mistake, is they think they worry about the money first. And I understand why you're worrying about it, because like you think you need to set that up or it needs to be in place because you don't want to find a deal, analyze it, and then can't raise the money, can't do this, can't do that. I totally get it. I was in that exact same boat years ago when I thought, gosh, like, how do I raise money? Like, I don't know anybody. People don't want to give me money. They don't, like, you create all these self-limiting belief systems. Totally natural. What you soon realize, especially when you get around to other people that are in this space, okay, it literally goes in this order. So I talked about debt and equity, but the deal has to come first, guys. Imagine this for a minute. If I came to all of you on this webinar tonight and I said, hey, listen, I have a 20-unit deal in Alabama. Projected returns are 18% a year on your money. It's a minimum $25,000 to get involved in the deal. And you're going to have ownership in the property. And your money's going to be out 3 to 5 years. And you're going to earn 14 or about 18% a year on your money based on the projections we have. And we're going to all own a 20-unit apartment building. And your response is to be, gosh, that sounds interesting. Can you send me some more information? Why, yes, I can. I'm going to send you a pitch deck. Give me your email and your information. I'm going to send you a pitch deck. It's going to break the deal down. It's going to give you all the information as to what the deal is, projected returns for you, how much money we need, how long it's going to be out, when you get it back, and how much you get back. And here you go. It's going to break it all down in nice, simple layman's terms for you. And we have those in templates, and those all go out to all of our mentees in our programs because we're helping them. How do you do the money side, the financing? You have to learn how to raise money, period. And I don't care what business you're in life. Literally, you could be selling widgets. You have to learn how to raise money. If you're running a company, if you're doing anything, if you're in sales, whatever it is you're doing in life, you have to learn how to raise money. You just need to remove the limiting belief systems, understand that the deal is going to drive the interest for the money to come in. And I'm going to give you a perfect example right now of one of our students who literally did this just recently and exactly how they did it. Okay, so I can give you a case study and a real life example of a student that executed on this. Okay, and it's happening every day. Every day. But you got to understand it's about your processes. It's about your systems. It's about the stuff in place. And if you have good processes, good systems, and you can execute, okay, that's how you get it done. So let's walk through an actual deal that a student recently did, okay? And kind of showcase this to you. They bought a 10-unit for $1.2 million, okay? A little over $100,000 a unit. They went and they were going to do, they did reno. They're going to do about $80,000 in improvements. The property was already improved, but a few units needed some renovations, so they're doing that. They got some credits from the seller and so forth, but about $80,000 in renovation that's coming in. And then closing cost, about $60,000 in closing cost. And I can break this down in just a minute, but $60,000 in closing cost. So the all-in cost on the deal, okay, was $1,340,000. Okay, all in. So they went out, and in this case, this was pretty cool. To get a $900,000 loan, you guys, is really easy. Does anybody know the difference between financing a commercial property and financing a residential property? And the difference is for how the bank looks at you. The biggest difference is this. When you go buy a home, okay, the bank's going to look at you personally. They want to make sure you can pay them back because that's how the loans are structured. They're residential loans. It's on you personally. It's not on the property. Okay, so they want your financials. They want your tax returns. They want your bank statements. They want your life. They want an they want an exam on your body, right? They want everything. They're going to take everything and they want to examine it because the bank wants to make sure that if you can't pay them, where are they getting their money? They're either foreclosing on you, they're doing something, right? They typically can't come after you personally anymore, but they want to know that financially you can make the payments. So that's why they analyze you hardcore. When you get to the multifamily, when I say multifamily, anything 5 units or more, 5 units or more is a multifamily property. Anything in that category, you are in a commercial loan space. What that means is that no longer are the lenders looking at you. They're literally going to take. They're going to take these financials and analyze them to make sure that when they get to this number right here, the net operating income number, debt coverage ratio, that is correct. Debt coverage ratio. All this means is that this number right here is 1.2 times or 120% of your debt payment. That's all it means. This is 1.25, 1.3, 1.4. All it means is your 1 point whatever times the amount of your debt payment. And that's all the bank wants to see. So if that number matches or more, and you're not a fraud, they're giving you the loan. They're going to give the property the loan. You see, they're giving the property the loan because the property is its own operating business. Okay? It's its own operating business. It has an income, has expenses, and it has a profit. That's it. And if it has enough profit, they give you the loan. It's not even about you anymore. So this is why you can get unlimited debt, unlimited properties, unlimited everything, and they're not looking at you. They don't care about you that much. It's very limited. So this is why it's literally easier. It is literally easier for these guys to go out and get a $900,000 loan, $1 million loan on a multifamily property than it is to go get a $300,000 house loan. Easier than doing that. So what they did, they got lucky enough and they got the seller to help them finance the property. So a little bit of creative financing. The seller literally came in and gave them this loan, okay, and gave them pretty good terms on it. I want to say they get like a 6% rate. I want to say it was a 3-year deal, okay, at 6% fixed, and they got in that kind of loan, which was great. Now we deal with this side, okay, so $900,000. Remember, we're all in at $1,340,000, $900,000 loan. So now they got about $440,000 left over. They got to figure out, how does it happen? How would you do it? How do you put it together? How do you make this deal happen? Well, keep in mind, this deal produces an 18% IRR, okay, an 8% cash on cash, and a 2.4 equity multiple. So if I came to you as an investor and in this deal and I said, hey, minimum investment's $25,000, you're going to get ownership in this 10-unit apartment deal, your projected returns are 18% a year on your money, would you have some interest? And you're going to own a multifamily apartment building. And your response may be, yeah, I do. Can you send me some information? Yes, I can. That's how that works. But the deal drives the interest. It's not the other way around. You don't go get all the money and be like, because you can't get the money. If you go ask people for money, they're going to be like, do you have a deal? And you're like, no? Okay, great. Come back to me when you do, right? That's how the money gets transferred, right? People want to move the money, but they want to move it into an actual deal. So the deal will drive. So go find good deals. You'll raise all the money you want, right? And we'll teach you how to do that. Teach you how to do that. So anyhow, how they did this, they brought in about 10%. Okay, they brought in about 44 grand. That's what these guys did. As the general partner in the deal, they brought in 10% of the amount that they needed. 396,000 was from investors. Okay, it was from investors. I'm going to break this down in just a minute to show you how they got it, who they got it from, and how they got it, and how they raised and brought in the 396,000. Okay, do that right now. So this is how the deal got structured. Okay, it's how the deal got structured. Make sure you guys can see this on your screen. So the property address had its own LLC, 123 East Street LLC. Okay. The deal was structured to where the general partner, which was them, they brought in 10% of the money. Remember, they brought in 44 grand. They got 30% ownership. So for 10% money, they got 30% ownership. Now here's the cool part. Here's the cool part. Let me touch on this real quick. So they brought in 44 grand. Okay. They got a Does anybody know what an acquisition fee is? And or why you would ever get it? Okay. So they got an acquisition fee of $36,000. Okay. $36,000. Yep. You're putting the deal together. Beautiful. So you're putting in a lot of time and effort and hard work, right? So you get paid multiple times. We're going to get into why you would own multifamily, because I'm going to show you literally a deal that I did, how much money I made on it, and why. And I'm going to break down the 4 different ways and the 4 different times in which you get paid while owning a multifamily building. Okay, because you get paid multiple times. You go flip a house 1 time. You wholesale a house 1 time. Okay, you get paid 4 times in multifamily. Technically 5 if you count the taxes, but at least 4 with 5th. Okay, I'm going to show you that. So they got an acquisition fee. Literally, they closed escrow. This is how it works. $44,000 went into escrow. $36,000 came out. They're out $8,000. $8,000 out of pocket. And they have control an ownership of 30% of a 10-unit building. Okay. Here's the cooler part too. And it gets even sexier. Their money. Okay. Their money. Okay. Comes over here. So when you do these deals, you get to what's called double dip. Your money actually goes in as your own investor in your own deal. So this is how they brought in the money. So 30% ownership to them for 10% of the money in. They gave 70% to the other partners that were coming in the deal. So they had the seller actually came in and left in another 100 grand. That's pretty cool. So now the seller's got $1 million in. He's got $900,000 in debt, right, as a lender, and he's got $100,000 left in as equity as a partner. Another person for 75, 50, 125, 50, and then their money is right here. So you actually invest as an LP in your own deal. You get to double dip. It's the greatest thing you've ever seen in your life. So you're getting an acquisition fee. You're getting 30% for 10% in, but think about it. You actually only have 8 grand in. You have less than that, right? Peter to pay Paul. And that is at the close of escrow. That's like day one. So you, right? 44, 36, you get paid. Okay. Now you're here. Now you have 30% ownership of this deal and your money is earning over here. You're earning money on this and you're earning money over here. So you're getting the double dip on both sides of that deal. So how do you get paid in multifamily? Here's how it works. You get paid an acquisition fee going in. You get an asset management fee for asset managing, not property managing, asset managing the deal of 1 to 3% of the revenue for managing it on a monthly basis for you, your partners, and everybody. Additionally, you're going to get the profit splits and the cash flow at 30%, plus you get your percentage over here. That there plus this here. So that's way number 3. Then you get a profit, 30% plus your percent here when you sell it or you refinance the property. So that's way number 4. Then a big 5th one, the taxes, right? Taxes. And this is where it's not about how much money you make in this life. It's about how much money you keep. And if you enjoy giving all your money to Uncle Sam in your local state taxes, then don't listen to me anymore. Don't listen to me anymore. I have not paid taxes in 8 years. And it's not because I don't make money. Okay. We make a lot of money. But the difference is we leverage real estate to do cost segregation, bonus depreciation, and that way we can accelerate write off against taxes and taxable income. And you can do the exact same thing. You can do the exact same thing. And we show people how to do this. So that's the big benefit. Okay. So 5 ways you make money in multifamily. Flip a house is 1, wholesale house is 1, right? Rental properties, Airbnbs, you get some cash flow, which is nice. Multifamily, 4 different ways, and a 5th being taxes. Does that make sense? So that is how they structured the deal. And they brought in the $396,000. They brought in their 44. And that is how they structured their own deal. Okay. Let me show you that one more time so you can follow up on it. So to kind of summarize it. Okay. $1.2 million property, 10 unit, 80,000 in reno, 60,000 in closing, $1.340 total cost. Seller financed them at a 6% rate for 3 years. They gave them $900,000 in debt, right? There was no debt on the property, so they gave them debt. Then they were raising $440,000, of which they brought in 10% of that, which was 44 grand. Literally brought it in and got $36,000 back the day they closed escrow. So they were technically out of pocket 8 grand. Okay. They raised the 396 just like this, as we showed. And we have all the tools, systems, and everything. We teach people how to do this so they're black and blue. It's not that hard. When you have a deal that makes sense, when you have a deal that's producing good returns, guys, raising the money is not hard. It's just not. If you have a deal that produces decent returns for investors and for people, people want to invest their money. You do. You want to invest your money. You just need a deal that makes sense. It's going to give you confidence you're going to get the money, right? And that you're investing with people that aren't frauds. I mean, that's really what it comes down to. So if it has a good deal, the money flows. If the deal's not good, you have a hard time raising money. If the deal's good, easy breezy. Okay. You just need good systems and protocol for it. Okay. So that's that. So closing on a deal, I'm not going to touch too much on this. These are the different steps of closing. You have to do inspections, the legal, the financing, and the renovations. There's a process for that. There's a lot of nuance in that. I'm not going to really focus on that tonight, but that is the closing process that you need to focus on, okay? And then managing a deal. And we're going to go a little bit over tonight. So if you can hang on with us, we're going to go about 10, 15 minutes over, but hang in there, okay? managing, you can self-manage. I do not recommend that. You can if you'd like. But property management, we teach people how to hire the property managers correctly. So that way you're not dealing with the toilets and tenants every day. You're not dealing with the toilets and tenants every day. You can go off and do what you need to do, stay in your current day job so you can earn money, pay for your family's bills while you're building this portfolio and this wealth. So that way you can make the transfer over. And you want PM companies that you know how to hire. We can teach that. It's easy. How do you hire them correctly so they can manage your deals? That's the management process. Okay. And then you become what's called an asset manager, where you're managing the managers. I do check-ins, so we have weekly calls with all our ownership teams around the country where I'm checking in. We're having weekly 30-minute calls with our property management crews, and we're going through some basic stuff. And then they're running it, and we're just doing high level, okay? So let me walk you through a 31-unit deal that we purchased, and I'm going to show you exactly how we did it, how much I made, what we did, and how you can do the exact same thing, okay? So for $18,000 out of pocket, $18,000 out of pocket, about a 31-unit deal. And controlled 40% of it, 40% of the deal. So here we go. Bought it for $1,525,000. This was in the Midwest, by the way, Midwest. We did $400,000 in improvements. The property is pretty dilapidated, needed a lot of work. So $400,000 in the deal, closing cost of $225,000. So we were all in for about $2.1 million bucks. We went out and got a loan, 70% loan for $1,500,000. This loan was easier, I kid you not, than going and getting a $300,000 or $400,000 home loan. Because why? They're looking at the property's financials. Then we had to raise $645,000. We did it literally the exact same way I just showed you. We brought in 10%, check, okay? Raised $581,000 bucks. We got an acquisition fee. Okay, so we're $18,250 out of pocket. Okay, out of pocket, and we controlled a 31-unit deal. Okay, let me keep going here. So what did I get from the deal? Okay, what did I get from the deal? In 24 months later, when the property had increased in value because we renovated it, raised rents, and now the value of the property was more, right? We did 100% cash out in 24 months. So literally, I want you to picture this for a minute. This is actually a killer deal. So 64 grand goes in, $45,000 comes out. Okay, so I have $18,000 in the deal. In 24 months, I get my $64,000 back on top of that. Okay, and all the while I'm earning an asset management fee of 1%. Plus I own 40% of the deal. So I'm getting 40% of the profits, 40% of the cash flow. About $2,000 a month over 5 years, 120 grand. Net profits on the sale at $470,000. So $590,000 I made on an $18,000 investment. That's a 32x. It's a 32x. You tell me where you can figure that one out. Not all the deals are this great, but this is a perfect example of an actual case study. Is acquisitions like wholesaling? No. Yeah, no. So acquisitions is, so you're talking about multifamily versus single family, I'm guessing. So you can wholesale in multifamily, FYI. So I deal with a couple of wholesalers all the time that are out there finding deals, and then they will bring them to us off market. It happens. So there's wholesaling in multifamily, but keep in mind, the sales cycle is long. That's why it's not that lucrative per se, because you may have to wait years before you're getting paid on a multifamily deal. So it doesn't, for the amount of time and energy you'd have to put into being a wholesaler in multifamily, go be a multifamily bazillionaire. Like it just, there's no point. So wholesaling single family is much more rapid sales cycle, so it makes sense. Same thing with flipping, right? It's 4 to 6 months. Wholesaling is, you're on it, you're moving if you get good at it. So there's benefits to that. Multifamily, keep in mind, you're getting paid 4 times and then a 5th with taxes. So there's multiple revenue streams, multiple times getting paid, big paychecks. I mean, big paychecks. I mean, literally, I'm not kidding you not. I'll tell you right now, since you're still on here for a few more minutes. Let's see, which deal was it? It was National City was 22. Now Don't get mad. So we just did a deal for 22 million bucks. Okay. And we got a 3% acquisition fee. Now we had another partner in the deal. So it was a $660,000 acquisition fee, of which I got half. Okay. Simply for putting the deal together and managing it, running the whole show in the beginning. Keep in mind, that's payment number one. And then we have 30% of the ownership, 30% of the revenue, 30% of the profits, refinance, tax advantages, all the other stuff coming in. Asset management fee of 2% on top of that for managing it every month. Plus, because we're doing the renovation and we're controlling the construction, I'm getting paid a 5% construction fee for managing the construction management side. It's just coming in from 14 different angles, guys. You get paid multiple ways in multifamily. That's why multifamily, multiple ways versus one way. That is the biggest benefit differential between doing single family investing and multifamily. You're going to start getting paid multiple ways all the time in multifamily versus one way, and having being a transactional game versus a long-term play game in passive income and revenue. The biggest difference. So acquisitions, by the way, is the process of acquiring a multifamily. So you have an acquisitions manager that gets paid money to go find deals. They're getting paid a fee, right, for finding deals. So, yes. So the question came in from Neil. Can you leverage the reno cost in your total capital raising? The answer is 100% all the time. And we did it. They did it right here. Give you a perfect example. Okay. They did it right here. Right. This is our students did this. Purchase price, renovation costs. Okay. And then your closing costs. This is the only thing that doesn't get covered, but your reno and your purchase price will. So we need 340 all in. They got a $900,000 loan, which included renovation dollars. Okay, renovation dollars. So yes, in your loan, typically they'll break it up. You'll have an acquisition portion of the loan and then a construction portion of the loan where you'll draw money on to pay for your reno. That's typically how the bank will divvy that up, but they will include renovation costs. Yes. Great question. Yeah, Neil, great question on the question on how do you pay back your investors? You pay back your investors through the cash flow and the profits on the deal. Okay, you can also refinance them later down the line. So let's say you're 2, 3, 4 years in the deal. You can refinance the property because now it's probably gone up in value. You've improved it. You can actually cash your investors out if you want to. That happens all the time. And now you own 100% of the deal at that point because you've cashed your investors out. You paid them back plus their returns. Okay, so that's how that goes down, through cash flow and profits and or refinance. Okay. Okay. Yeah, great point, Steve. You said finding deals and balancing time with your current job is the biggest roadblock. Hear it all the time. Hear it all the time. The question is, how bad do you want it? Because if you kind of want it, you're probably going to spin wheels, and we all know the definition of insanity is doing the same thing over and over and expecting a different result. So there has to be enough pain, kind of your current situation on where you're at with your job, where you want to go. Okay. Would it help to have somebody hand-holding you through these different steps and roadblocks to get you to where you want to go? What is that? Is there a benefit to that? Is there a benefit to being inside a community, right? To where you can learn this stuff and get handheld and mentored by even someone like me and our team and everybody that we're doing? Is that beneficial to somebody to get you into a deal in the next 90 days or by this year and handhold you to go through that, both emotionally, physically, help with all the different finding, analyzing, raising the capital, closing, and managing these deals? Is that worth it? So, that's really, yeah, I love it. Oh my gosh. Contributor versus creator. Yeah. You must have watched my video. Yeah, it's exactly it. It's exactly it. Right? How long do you want to be a contributor to the economy versus a creator? Because creators are the ones that make all the money. Contributors, you're literally just spinning wheels. You're earning a good income. Maybe you're in a great 9 to 5. Nothing wrong with that. But I know you want more. Of course you want more. Otherwise you wouldn't be here tonight. And you're trying to learn this stuff. Well, it's great to learn it, but it's one thing and then how do you execute? And most people like me, I got mentored years ago, and it was worth its weight in gold. I would never be where I'm at today. Being handheld through this process of the nuance that you're going to go through in each one of these little roadblocks and things that you're dealing with is key. It's key. So look, if you guys, if anybody's interested, this is what we're going to do for everybody tonight as we kind of finish up here. If you guys want, is if you have interest, and don't share it with everybody in here, you can select host and panelist. Put your name and your phone number in there. If you have any interest in kind of learning more, maybe being handheld, looking for mentorship, other information about multifamily and getting more details, we'd love to speak with you about that. And I'll just throw it straight out. So that way, being in the community, investors around the country, as I mentioned earlier, it's about community collaboration partnerships where people are doing deals together, money's being raised together. We're partnering on other mentees and other people in the community doing deals and bigger deals around the country. We love that stuff. And if you have interest in a mentorship at all, okay, I'm going to lay it straight out for you guys because we're doing something kind of unique tonight. So it's $7,800. Okay. Don't worry about the money for a minute. Okay. Because what we're going to do is we're going to take that off, right? We're going to take $1,000 off. If somebody is interested tonight and you want to do it, just put your name and your number in the private chat to the host and panelist, right? Select that in there and let's just get information, right? And you make a decision whether or not it's the right fit for you. And what is that going to get you? It's lifetime into the community. So it gets you lifetime access to everything and anything, right? You're going to get a 12-month mentorship with me, not some random hired coach, not some students wannabe coaches, me, just like this. Every week, we're going to be doing this and we're going to move the needle for you and get you into some deals that are going to make sense for you. Okay. And then you're going to get all the tools and the systems. So literally every single thing that we use in our business, you're going to get everything, like literally everything, right? Deal analyzers, letters of intent, all the documents, legal, pitch decks, anything and everything you can, due diligence checklist, anything and everything you can possibly fathom that you'll ever need to buy an apartment building, we provide you, right? And then we're adding things every single week and month to the program as people request it because it's great. So there's a ton of stuff. I don't want to get into all of it, but if you have any interest, drop your number and your information in the private chat and we'll reach out to you personally right after this webinar, right? So right after this webinar, we're going to call you and let's just have a quick chat, see if it's a good fit for you or not. Maybe it is, maybe it's not. But if you really want to move the needle for yourself, now's the time to do it. So yeah, I mean, that's pretty much it. I mean, I want to open it up to any more kind of Q&A if you guys have it. And, otherwise, I hope this was immensely valuable for you tonight to kind of go through the different steps. We're doing an amazing job. And like I said, really what it's about is this, everyone. It's truly about this. It's truly about that. Because I know, this is what I know. It's not about mentorships and courses. That's a piece of the puzzle because we need to know you're well-trained and you're executing and you're having success. You're becoming a millionaire. You're making all your dreams come true and doing truly what you want to do, right? And having more time, freedom, all the things, right, that are driving you. We talked about those 7 mountains earlier, right? That's where you want to go. That's the movers and shakers for you. But it is about the community because we know that if we can have well-trained investors in the community, like everybody in here, everybody starts doing deals and more deals together. And you're doing it all over the country, right? West Coast, Midwest, East Coast, all over the place. And people are collaborating and partnerships happen. That is where it's truly at. That's what it's all about. That's the big picture because that helps us get to where we want to go because we want to partner with people because we can't see every deal. I mean, maybe you can bring us a big deal. I don't know. A bigger deal than you could take down on your own. Let's do it together. We would love that because we have the capital. We have a $25 million multifamily fund. We're buying stuff all over the country right now. We're looking at distressed stuff. We're looking at non-distressed stuff, but we're typically looking at some larger deals, but we would love to partner with people that want to take action. So, yes, and we see the stuff in the chat and we'll make note of this. So that way we can reach out for the deal analyzer, Victor, on that. Not a problem. Perfect. Yeah. And any other questions anybody has, please let us know. Please let us know because we'd really love to collaborate with you if you have interest. Like I said, don't worry. Listen, don't worry about the money side. Don't worry about that. I try and be very transparent with people, but we're giving people a smoking deal for everything you get. Trust me, it's worth 4 times that at least. So just trust me on that because you're getting an intimate access, by the way. You're not a big, small fish in a big pond on a massive conveyor belt system where there's 10,000 people in it. You can't get access, right? We have success coaches that will be assigned to you. You have me, you have our entire team collaborating with you on a weekly basis, direct access to my cell phone, my personal email. Like, we're going to work through this thing with you to answer and help you all along the way. And then we establish and we put in, you know what? We actually have, I didn't even share this. Can't believe I didn't talk about this. We have a 90-day guarantee, by the way. I didn't even talk about that. We have our 90-day guarantee. So if we don't help you locate a deal that makes financial sense for you within a 90-day window, you can request a refund. Okay? Period. So, yeah. We're trying to make it as easy as possible. It's such a screaming awesome thing, and the collaboration that's going on. If anybody has interest, we'll leave it at that. So, beautiful.